From Washington, this is the Macrocast, a podcast brought to you by Penta and Markets Policy Partners.
Good morning. It's Friday, November 18th, and you're listening to the Macrocast, brought to you by Penta and Market Policy Partners. I'm Stratton Kirton, Managing Director at Penta, here with John Fagan and Brendan Walsh of Market Policy Partners. John, Brendan, welcome, and tell me what happened last week before the kickoff of the official shopping season. So what do we need to know?
Yeah, we had a lot of retail-related information coming our way this week, and not all of it was bad. Expectations were obviously a little bit muted. Clearly, the consumers have been dealing with a lot of headwinds, high energy prices, high food prices, across the board. We're all familiar with that. But the stalwart U.S. consumer is soldiering on, and some of the, but it's definitely not easy going. We saw, I'll kick it over to Brendan to talk a little bit more about the retail sales, but the earnings picture, the U.S. retail sales came out alongside a bunch of major big box U.S. retailers giving their third quarter results, and Walmart was sort of the star of the show. You got again, the discussion. It's not exactly like the brightest of outlooks, but the idea of wealthier shoppers going to Walmart to access the cheaper groceries and to continue keeping up their purchasing volumes and so forth in the face of higher prices. Walmart has worked through its big inventory backlog and has really benefited, I think, from a very deft and savvy management of the current macro dynamics and inflationary and supply chain problems. That couldn't be said for all of its competitors. Target took an absolute walloping as its profit fell. It was forced into steep discounts in order to clear its backlog. And that was a pretty grim message to offset the positivity of what Walmart was saying, and then we got Lowe's, the home improvement giant, pretty good numbers there, and it kind of speaks to what people sort of thought, maybe a flashback to that pandemic dynamic in which people aren't really moving. They're not moving for different reasons now because the affordability is absolutely horrendous and it's a completely impossible time to buy a house. So once once again, the upgrade story, just to make your current residence a little bit better with home improvements is the story behind that. But there was a lot of nuance, and I'll kick it over to Brendan to talk more about the actual retail sales number.
Yeah, so in September, retail sales were flat. So it was kind of a consensus amongst people that, the higher rates is definitely, slowing consumer spending. We're also seeing that, a lot of the huge savings that people racked up during the pandemic is slowly, getting spent. But then the October retail sales surprised very much the upside. They were up 1.3%. And it was heavily on the back of, going out to dinner and experiences things, but also all the supply chain bottlenecks at car dealerships, new car dealerships have been loosening up. So dealers finally have inventory, and people went out and bought some cars. Yeah,
the holiday season coming up is still a real question mark. Amazon, it was not upbeat about the holiday
pretty much
season.
Everybody guided down on their holiday sales outlook. They don't necessarily see 2023 as a disaster, but people have been buying earlier, and I think that's a new trend too. We start buying for Christmas, starting in August and things like that. So you don't have this crazy surge at the end of the year. But also, the consumer bought so many goods during the pandemic that, services and experiences are much more interesting. So there's definitely it's not like a disaster outlook for the holiday spending season, but it's not going to be better than previous years.
Well, so that sort of got to my next question. I was going to ask, based on sort of the economic tea leaves, do you have any predictions for what we're going to see for Black Friday and Cyber Monday this year? Are they still really important shopping days for retailers?
Yeah, I mean, the conventional wisdom in the markets is that the emphasis on those particular days is a little bit misplaced. It is spread out, as Brendan said. It's elongated, and the deals and that sort of thing start popping up earlier at different times and so forth. But they are, they're still definitely the Black Friday and Cyber Monday sales are definitely salient data points that people are going to be focused on. Expectations are muted, as we said, and so that usually is a indication that it's not so difficult to generate an upside surprise. But at the same time, consumers are beginning to dip into the credit lines, that sort of thing, getting their household balance sheets, putting those on the line to keep their spending up. There's also, these other wild cards like, weather, and that's where we've got a very, early sort of cold after a very warm October in a lot of the country. We've gotten this big cold snap coming up, and so it's sort of the question of, whether and then of course is that we can get into the discussion of oil prices, but gasoline prices have been, not where the White House wanted them, but they are, certainly well off the peaks that we saw of earlier this year, and oil prices notably are coming down.
Yeah, they're likely, gas prices, kind of across the nation are likely to come down between 30 and 70 cents in the next.
At least just because of the seasonal decline, right?
Exactly. Yeah.
Okay.
But then it could get even bigger as oil prices are dropping, and a lot of the drop in the oil prices is China related, as they keep locking down and maintaining this COVID zero policy.
So if you're looking at this consumer spending and trying to do what everybody else is, which is figure out, what the Fed's going to do next, how do you apply, what we learned from the reports and the earnings this week?
Yeah, I mean, the market's reaction function has been, I think, very much driven by Fed commentary, and Fed commentary has been, pivoting a little bit here. I think pivot's a loaded word, right? We've flagged this a lot. It's more of a
transitory. Now it's pivot, and what do both mean?
Yeah, are they really pivoting? I mean, they're obviously they're flagging the fact that the rate hike trajectory is going to be leveling out here. You can't do 75 basis points every meeting from now until eternity. And so it stands to reason that they've gone far enough. They're signaling that the next move is probably going to be 50 basis points and then, potentially lower beyond that. That is, for the markets, that's very exciting, right? It's the beginning of the end, and maybe the peak is in sight, and that is really that's been a tantalizing prospect for the markets. We haven't seen, despite all of the the hawkish barrage. It seems like every day there's another gauntlet of Fed speakers just battering the market with this hawkish messaging. But at the same time, they are saying they're now beginning to acknowledge progress on inflation, some encouraging things that they're seeing, a bit of balanced kind of two-sided risks of the growth on one side. And so a little bit more of a balanced treatment, a little bit of a downshift in interest rates. They keep trying to create this verbal hawkish, tone that to try to keep the markets from getting too excited about this downshift. But it really is like every good data point, like the retail sales, makes markets think on the margin the Fed is going to need to be incrementally tighter. So we've seen sentiment kind of pivot around that this week.
No, I thought it was interesting. Yesterday, James Bullard, the headline and his conclusion was that the Fed policy rate should be somewhere between 5.25% and 7%. And he provided a chart to justify that. And the chart was based on a rules-based Taylor rule, which combines, inflation with unemployment, things like that. And he showed a gap based on the October, CPI reading and where the current Fed funds rate is. And that's how he got to 7%. When I looked at the chart, what I saw was that the Fed didn't raise rates for a year and a half when they should have under this rules base. And I see the chart showed me that the Fed is already over tightened because we already know basically what inflation is going to be for the next couple of months because we have kind of real-time data. And we know that inflation is really falling off a cliff. So the Fed, Wayne Gretzky said, skate to where the puck is. the Fed's not only not skating to where the puck is, they're not
skate to where the puck is going.
Yeah, they're not only not skating to where the puck is going, they're not even skating to where the puck is. They're skating to where the puck was months ago. So, I think that the big risk is that the Fed is so obsessed with tightening and proving to markets that they're tough, that they're setting themselves up for a scenario where they're going to have to reverse course very quickly in 2023, where the data that they say that they're watching is going to not justify further tightening, and worst case scenario is that monetary policy does work with the lag, and they raised so much to because they got so far behind the curve last year that they put us into recession.
So if it's not a soft landing, do we have a new term, a phrase we want to coin?
It's either going to be a soft landing or a deep recession. There's not too many other.
Well, I think that the argument really, and the market's argument is essentially, is it going to be the recession is almost like a fait accompli at this point, is the way that markets are treating it, right? You've got the inverted yield curve blaring a recession signal. And market participants really take that to the bank, so to speak. And it's the deepest inversion of the 2s-10s curve since 1982. And that is, consistent with, one would assume, the economics department of, Goldman Sachs and other leading places on the street calling for a mild recession. That, of course, they're going to call for a mild recession. They tend to, gravitate toward centrist and less tail kind of outcomes, but the debate really seems to be around: is this going to be a short, a short and fleeting recession, or is this going to be a deep, dark and potentially really damaging kind of retrenchment of the economy next year? And it's the fortitude of the U.S. consumer, the decent shape that the balance sheets are in, the low level of corporate leverage. These are some of the things on the positive side. Oil price and commodity prices coming down, supply chain things easing up. That's suggestive of maybe some support on the other side. The idea that this is the Fed's weak growth is already weak, and the Fed's generationally steep tightening cycle and the spike in the dollar feeds through into the economy with a 6 to 12 month lag, and so it's really going to be punching the economy where it hurts next year. And we haven't even, and the economy's already weak going into that. So it really is a very challenging debate. We hosted David Rosenberg, an esteemed and tend to be very bearish economist, yesterday. That you can find that on our the Markets Policy Partners YouTube channel. We put the video replay up. It was a fascinating discussion. He is in the camp of deep recession forces the Fed to start cutting rates aggressively next year, and a deflationary wave replaces our inflationary moment that's currently in effect.
Well, I guess interesting to hear, if not the news we might want to hear. Well, so we were talking about a pivot, so let's do a quick pivot before we take a break. I think we'd be remiss if we didn't talk about crypto and specifically FTX. So what do you guys think? I feel like the conversation still trying to figure out entirely what happened, how much was structural, how much was malfeasance. But I feel like the most important question now is contagion. What do you guys think? Is this going to be contained, or are we going to see this reverberate in other areas of the market?
So if you're looking at this episode from the seat of a policymaker, right, you will be feeling probably pretty reassured that the contagion aspect has been minimal, right? We've seen some reverberations in tech stocks and the tech stocks that are wrapped up in crypto. Obviously, the crypto complex is really struggling with this. The crypto analysts and leading lights all say, this still has a lot, to go, a lot of miles to go through in terms of deleveraging, the forced sales that are going to hit this system. But with all of this volatility and an Enron moment, a Lehman, pick your analogy in crypto, it really hasn't spilled over into broader markets in a way that is that's really observable, or potentially, and let alone systemic.
Yeah.
So that has got to be very
over within the crypto universe. I think that narrative, that reality is just beginning, because so many of these companies really, they just kind of invested in each other and created an ecosystem that doesn't really have outside use. So I do think we're going to see a lot more bankruptcies and a lot more companies. I mean, we're already seeing it. So I think that reality is just beginning.
But it happened before. I mean, fortunately, this happened before. I mean, crypto is in the process of being mainstreamed, but it was hardly mainstream, right? Widows and orphans don't have their money in crypto for the most part. It's a speculative vehicle. There was a lot of, buyer beware. The big institutions that allocated meaningful sums to it are only meaningful in the, in the broad sense of the word, not necessarily meaningful in terms of the percentage of their portfolios.
And we're never part of the actual economy, so there's not a systemic risk from that front. If a coin goes down or exchange goes down, it's not like people are going to lose their ability to feed themselves.
You can create a scenario, obviously, where you can always put together some sort of daisy chain of of bankruptcies and defaults and that sort of thing. But it sure looks like, at least at this point, that the crypto earthquake isn't rattling the windows in regular, the real economy, regular financial markets.
Let me ask one last question, and then we'll take a break. I was speaking to somebody this week, and they made the point, that this is an industry, both because it's new and because of its complexity, that lawmakers on Capitol Hill really, really struggled to even just understand it, let alone get proper oversight. So what do you think, if anything, we'll see as a reaction from Capitol Hill to what happened this week?
I think the crypto cognoscenti are concerned that this episode with FTX will embolden regulators to really clamp down. Honestly, we're kind of taking a different approach. The regulators are looking at this episode and saying, hey, this is making the point that we've been making, that, crypto has a lot of problems. We've seen a real world example making our point for us better than we ever could. There isn't spillover into broader markets, as we said. And so in cases like this, regulators tend to let nature take its course, I think, and rushing into a regulatory response, you've got a bill up on the Hill that is intent on trying to get crypto put into the category of commodities. I think that is probably, our guess is that this FTX episode undermines that approach. That would look toward the Capitol Hill and Congress sort of, blessing this asset class and giving them some, legitimacy where, they may not deserve it. And so we think that the regulatory approach will remain deliberative. The SEC will obviously, has already said that it sees these as securities and, can put more resources behind it without having any legislation. So we think that the legislation is going to focus on stable coins. We think that the stable coin, the algorithmic stable coin ban or hiatus for 2 years, we think that bill, that's the kind of thing we think is going to pass. We think that regulations of stable coins and what kind of collateral they have backing them is going to be the focus. We are talking our own book here. We have business interests in this side of things, but our own interests aside, that's where we think regulation is going to be focused and going. Focused on stable coins and letting crypto kind of collapse on itself and then kind of coming in when the dust settles, maybe a little bit.
At a minimum, the crypto lobbyists' Twitter tweets are way less arrogant lately.
Well, I feel like anything relating to Twitter these days, maybe lots of crazy things going on. Well, so that's a good transition because we'll take a break and then come back and talk about Congress, the election, outlook for 2023, and then some of the global meetings that are taking place right now and their economic outlook. So with that, let's take a quick break. I'm Stratton Kirton, and you're listening to the Macrocast.
Penta is the world's first comprehensive stakeholder solutions firm. We are a one-stop shop for the intelligence and strategy leaders need to assess a company's reputation and make decisions that improve their positioning. as executives in the C-suite must account for a growing set of engaged stakeholders, all with distinct, fast-changing demands. Penta provides real-time intelligence and strategy solutions. We work with clients solving complex global challenges across a variety of industries. Our clients span technology, financial services, energy, healthcare, and more. To learn more about how Penta can support your company, check out our website at pentagroup.co, our Twitter at PentaGRP, or find us on LinkedIn at Penta Group.
Welcome back to the Macrocast. I'm Stratton Kirton, Managing Director at Penta, back with John and Brendan from Market Policy Partners. So this week, we finally sort of got election results for the midterms. And then we also have the wrap up of COP27 in Egypt and the G20 meeting in Bali in Indonesia. So John, Brendan, let's start with the midterms. What do you guys think this means for 2023? We're going to have a divided Congress, Democrats in the Senate, Republicans in the House. What does this mean for, oversight, for economic regulations, for where the time and attention of members on the Hill is going to be focused?
Yeah, I thought, our view coming into it was not that different than consensus. We thought it would be split government. We had the sort of late breaking polls that pushed the Senate into, likelihood of Republican control. We weren't really sure about those. Our base case for a long period of time had been Democrats keep the Senate, Republicans take the House. And, that's how it played out. We didn't, obviously, there was a lot of uncertainty around it. And but the markets had been leaning into this divided government, and that's what they got. And there's even an argument to be made, I think, that the way in which government is divided sort of clips the wings of, in some ways, maybe it empowers the very, the fringe elements of both. But, with narrow majority like that in the House, it's going to be hard for House Republicans to really take on some of the things that would shake the markets, right? A lot of the stuff just isn't on the market's radar, like the January 6th stuff. That's very political, and it doesn't affect day-to-day market pricing usually. But things like the debt ceiling, the idea that an empowered and united Republican Congress could basically hold the White House feet to the fire on things like Social Security and Medicare, with the debt ceiling as the hostage. Well, that's a tougher thing to do with the pretty threadbare mandate that the House Republicans were handed, and Mitch McConnell, who's no fan of this strategy in the minority control in the Senate. So it seems like this you can put this in a position where, with that narrow majority in the House, you can have some common ground kind of legislation. And despite all of the political vitriol, as they actually got a lot done. There was a lot of bipartisan cooperation and legislation. And so that maybe the legislative push is over, but you get something, that could still be meaningful in terms of whether it's a continued legislation on the U.S.-China front, that competitiveness aspect. It's sort of a low probability, but some potential. That's the U.S.-China area has been someplace where Republicans and Democrats really have seen eye to eye on certain things. But it seems as though this is going to be there's going to be a lot of headlines, but not a lot of action. And that's fine for markets. You can focus on things like, another sort of crypto regulatory, a relatively long and deliberative process on crypto that could be a legislative focus as well.
Yeah, I fully agree. I feel like the sort of investments in U.S., whether it's infrastructure or otherwise, sort of the coalescing around a general agreement on industrial policy, at least in a limited fashion, is back. That actually has, I think, a lot more bipartisan support than has really been covered. And I feel like every 2 years at the end of a Congress, we start seeing a wave of stories like you were referring to, John, where it's like, oh, wait, this Congress actually did get a lot of things done in a bipartisan fashion.
How about Manchin's permitting bill? Is that potentially on the table?
I mean, that's it's an interesting divide because, the White House is obviously fully behind it. I think Manchin probably has the votes in the Senate. And I guess the question is what happens in a lame duck with the House, when Democrats are going to be out of the majority in January? Do they let it happen, or do they stick to their guns? I mean, it's really it's interesting because despite the fact that I think there's been a real push to sort of reframe and relabel that bill as something that can benefit the clean energy economy, there's also a very strong narrative from some of the environmental groups that are probably on the furthest left who are really branding this, as a subsidy for fossil fuels. And so this is not a satisfying answer to the question, but I think it's really going to be a matter of which narrative wins out. If members can go back and sell that as something that's necessary to enabling the clean energy economy, then it's going to pass. And if they can't, then it's probably going to be kicked to the next Congress, and we'll see what happens.
Stratton, what else do you think might be on the legislative agenda for this finely divided Congress next year?
I mean, I think you really hit it, particularly in the House, is, it just mechanically enables a lot of oversight and sort of like flag waving. So investigations, lots of investigations, spending during COVID, personal investigations, of the Biden family and things like that. But I think to your point, it's on the one hand, while there, are and should be, concerns about the House holding things hostage around big moments like debt negotiations and maybe government funding, I think for the rest of the legislative agenda, it probably actually doesn't enable, the most contentious parts of the Republican faction in the House.
As part of the inquiries on COVID spending, do you think that the Fed is going to be on the hot seat over some of their alphabet soup of programs they put in place, which, let's face it, looked a lot like fiscal policy?
Absolutely. I mean, I defer to you and Brendan for more detail, but I feel like the Fed is one of those institutions that, people on the left and people on the right can always find a reason to be unhappy with them. And that's sort of where they are right now.
Absolutely.
All right. So from very narrow domestic focuses with the new Congress, should we talk about what's happening in the global economy right now? We had two really big moments at the end of the year. To steal a phrase from somebody else, I believe it was from a reporter from FT, it's like we had the G20 meet and COP meet, and it was, quote, billed as the first global summit of the second Cold War. So it comes at a time not only with Russia, Ukraine, but obviously US and China. And so I think some interesting stuff based on how expectations were set and what is emerging as outcomes. You guys have any thoughts on that before I jump in?
No, go for it. Take it away.
I think because of those tensions that I mentioned, and obviously Russia and China, both members of the G20, and obviously particularly with China, significant role with COP27 negotiations and climate negotiations, expectations for both of these were set extremely low. And I would say it looks like G20 not only is going to meet those expectations, but actually exceed them in a pretty healthy way. And COP they're still working on the final negotiating text at the time of this recording. But it looks like COP actually might not even meet the pretty low expectations set for them. But I think really, the narrative that I found was most interesting on the G20 is Indonesia had the presidency this year. India has the presidency next year. Brazil has the presidency after that. It's the first time in the history of the organization that you have leaders from the global South hosting the presidency multiple times in a row. And a narrative really emerged that those countries, along with other developing countries in the G20, didn't want the G20 to fall apart right at the time when they were taking the helm of it. So they worked really, really hard to make sure that the G20 summit was successful. They actually got a communique out. And the strategy that they used is make it all about the economic lens. It's like geopolitical tensions, you can't avoid that, but don't focus on that. Focus on the economic consequences of those. So you even saw some text in there about the war in Ukraine with some pretty fudging language, but really in the context of what it's meant for economies with food prices and with energy prices and with global inflation. So I thought that was just fascinating.
Yeah, hats off to Indonesia, and what a masterful job of diplomacy. And this is a country, by the way, from a market standpoint, Indonesia had been lumped, perennially in like the fragile, whenever there was a problem in global financial markets, Indonesia was, in the in the bucket of the fragile five, or one of those countries whose currency always swoons. Look at their performance this year. It's absolutely incredible and so encouraging. The currency has been strong. The economy's been great. They have a fantastic demographics story, but they have an economy that is well diversified. They've got the commodity story. They've got tech. They've got a lot of tailwinds. Great management of the and technocratic management of the financial system and economy, and their currency is holding up extremely well against the dollar, despite the fact that it's and that's not just a makeup for a big swoon last year like you see in the Brazilian real. It's a great success story, and for a country that has really been on the rise, and so this is a fantastic and really really validating debut on the world stage for Indonesia's leadership.
Absolutely agree. And I mean, I think they really did this to demonstrate global leadership, but also, skillfully negotiating on behalf of their own economy too, because one of the bright spots that sort of runs in parallel to COP27, but isn't part of the negotiations themselves, are the just energy transition partnerships. We saw last year a group of countries led by the G7 put together an $8.5 billion package, mostly concessional loans for South Africa. Indonesia this year, they announced over $20 billion, so real money, particularly when you're talking about the power sector in Indonesia as well. With that, I think the only other thing I would add is, the central tensions of COP come down to what it always has been. It's money. And I'll steal something that I saw from an advocate from E3G, a climate advocacy. He said COP wearing a big button that says, it's all about WTF. Where's the financing? Yeah. And that's really still what they're struggling over is $100 billion annually pledged by wealthy countries 10 years ago, never materialized in the full amount. And now, developing countries are talking about loss and damages, not just money for mitigation and investing in clean technology, but we're experiencing climate change now, and who's going to pay for that? And it's the big fight is just over money. It's always back to money.
That's the root of all evil.
Or progress.
Yes, both. Excellent.
All right. John, Brendan, any closing words?
No, we've got a holiday shortened week next week, and we're going to be coming to you with the Macrocast traditional Black Friday special. It's our perennial Black Friday warm up. We cast an even sharper eye on the consumer and on turkey prices, stuffing prices, so forth. But we've got a bunch of other data on the calendar next week. What else is going on in the shortened week, Brendan?
It's actually a fairly busy week on the data front, even though everyone's going to be kind of traveling, going out and about. We get all of the global PMIs. So that'll definitely give a very important insight into the service and the manufacturing sector, where the manufacturing sector in a lot of the globe has been in recession, contractionary territory for the last few months. We also get a host of housing data for the U.S. following on actually a host of housing data this week, which has really shown that the U.S. housing market is in a pretty deep recession, and that both inventories are increasing, prices are coming down, and there's very few buyers because the mortgage rates have gone up. Though they have come down a lot this week. They've actually come down the most on record on a weekly basis, but that's because they went up about 6% or 4% in the course of 2 months, and that'll probably do it. Then we'll come back to a week that will show the non-farm payroll December 2nd, which will be a very important data point also.
Brendan, as somebody who bought a house this spring, I was feeling pretty bad about that price point I paid, and I'm feeling a lot better about it now.
Well, especially because you have a 3.5% 30-year mortgage attached to it.
That's right. All right. Well, looking forward to it. Everyone, thank you for listening to the Macrocast, brought to you by Penta and Markets Policy Partners. Feel free to follow along at pentagroup.co. or at Penta GRP on Twitter. Have a great weekend and have a great holiday week.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.